good morning. You're watching The Market right here on 18 Hour with me, Aisha Faridi, Nikunj Dalmia, Avan Dabash, Nayantara Rai in the studios. And, well, after a day's break, surely the markets are on shaky ground. In fact, to be honest, what happened on Wednesday and the kind of plunge that you had, closing in at the lowest point in the day, down about 226 points. And we've breached that critical support of 18,000. Of course, 17,800 continues to hold. But let's see which way we actually go from here. But FIIs, they continue to remain sellers. Excruciating pain in the markets on Wednesday. We saw selling to the tune of over 2,000 crore rupees, and we fell 1%, over 1% also on Wednesday. And I guess a lot of it, Nikunj, was to do with the way all the news flow around the Adani Group of stocks, which alone have lost about almost 1 lakh crore rupees in market cap.
Yes, Aisha, we'll talk about extensively what's the way forward for Adani Group of stocks. But in general, if you have to look at all the other factors which are at play, FIs are sellers, crude prices are inching higher, the market breadth completely got punctured. Day one of last day of FNO expiry with added to that extra element of volatility, and then you've got budget which is around the corner. So it is not just Adani Group of stocks. I guess some of the overowned stocks from the PSU banking space, from the defense space, from the financial space, they completely caved in. So I wouldn't say markets are nervous, but markets surely are lacking momentum. There is no inertia. You look at the market from the eyes of Nifty, Nifty has been remarkably resilient. But the hollowness in the market, I think, is getting exposed with each passing day, considering that how markets are reacting to bad news, how they're speculating in terms of where the entire long-term taxation structure would move. And even though earnings by and large have been in line with estimates, there is nothing very alarming which has come out from India, and so far the market reaction to earnings, I guess, is very muted. So these are typical telltale signs that in the near term the market is they are not in a momentum groove, so to speak, and that really may continue till the time the budget is not over. Look at the reaction. I mean, we are overreacting in a lot of cases. There is just no reaction to good news. Numbers have not been that bad, but the overowned stocks like PSU banks, Adani Group of stocks, everything in a sense is just getting pushed to a wall. So low volume sell-off, but the impact of low volume sell-off is high in terms of the stock price.
Yeah. And the fact that financials and autos as well, financials in particular dragged the way they did, it clearly smacks of pre-budget positioning, I guess, Nikunj.
There is no pre-budget positioning. This time markets in the run-up to the budget, I guess, are very, very nervous. The nervousness could also be a factor of what is happening.
No, you want to lighten positions ahead of the big event.
You want to lighten your positions, and when do you want to lighten your positions? You want to lighten your positions, either you don't expect that the event is going to be a market friendly event, or there are going to be changes in the tax structure, especially LTCG and STG, which in the short to medium term will have impact on the market mood and absolute return potential. You are nervous ahead of the event because you're uncertain. When you're confident that the outcome is going to be strong, you want to approach the event with long positions. So markets are nervous, they're tentative. My sense is that the nervousness is unnecessary. This is purely looking at the track record of the last two budgets, where the budget has not changed anything on the taxation structure, where the budget has been growth oriented, where the budget has done everything in terms of accelerating growth, the multiplier effect to boost the infrastructure and kickstart the economy. So the tone of and the tonality of the last two budgets, despite the COVID, I guess has been very reasonable and very predictable. But markets are markets.
So the nervousness is unwarranted prior to the budget, you're saying?
Considering the track record. Considering track record. And now the debate, I guess the realistic argument and debate what we should have is that from a market standpoint, Avan, there are two things which matter. Which way the directional move of the government is in terms of the infrastructure spend and maintaining this fiscal deficit and, ensuring growth is strong, and how we take a leap forward. And second is taxes. Within taxes, from a market standpoint, it's about personal taxation. Will it go higher? It should ideally go higher. And second, LTCG and STCG. Within LTCG and STG, more than rate, I think it's a tenure, which is what we need to debate. So there is nervousness, there is no participation, everybody wants to come back after the event. And the silver lining here is that if we come on the right side of the event, then we could see a meaningful comeback.
Yes, indeed. But let's move away from the overall market setup and talk about one cluster of stocks in particular, and that was the Adani Group of stocks. Now, on Wednesday's trading session, there was an American short seller, Hindenburg Research, and they came out with a report. A lot of allegations calling out the Adani Group for malpractice, saying they've manipulated the market and there has been accounting fraud. Adani was quick to react to that, saying that it has been absolutely malicious and mischievous and an unresearched report. We did see the Adani group of investors pour by about a lakh crore in market capitalization in that one day. But Nikunj, what is your assessment as to how one should look at what really transpired Wednesday?
Look, the fall in Adani Group of stocks and the sell-off in the Adani Group of companies' debt, I guess, was rather excruciating. So you just read out the numbers. The fall, I guess, was very powerful. Now let's put facts out here. Hindenburg Group came out with a report. Adani Group of stocks have been massive outperformers. Sometimes when stocks are massive outperformers, they need a reason, and this report acted as that catalyst to trigger the sell-off what we saw on Wednesday. The debt concerns is something which markets have debated in the past, so this is something which in a sense was just acted as a trigger point. But as a channel, we are not going to be opinionating on the right and the wrong of the report. We are simply putting out facts. The report came out, it raised concerns about debt and a lot of other issues. But experts who've been on the channel, who track the Adani Group of companies, they are of the view that a lot of concerns which in a sense have been raised by the report by this Heidelberg Group is something which is old, and there's nothing new about it. Adani Group has come out and indicated that they could potentially take a punitive action against the group, and then Heidelberg Group last evening tweeted that they stand by their research. From a market standpoint, there is more clarity which markets would like to hear from the Adani Group of companies in terms of clarification and the concerns and the allegations which have been raised. We've not heard anything particular about it. Global media is reporting that Adani Group of companies may come up with clarification as early as today, Friday. So we will wait for it. The stocks have seen a back-breaking move, and that in a sense is going to have an impact on the market sentiment per se, because these are stocks which are the haloed stocks, and when a performing group corrects, it just raises question mark on the market internal texture. Then is the FPO part. What happens to the FPO? The anchor investor book on day one itself is already filled up by global and local institution, but for retail the IPO opens now, and I guess from a market standpoint, markets would wait to hear for more clarity and more clarification from the Adani Group of companies. But we are simply reporting facts. We are not opinionating anything about the report. Experts who've been on the channel, they are of the view that what the report has raised, a lot of concerns have been raised in the past, but markets, I guess, would wait for clarity. These stocks will remain volatile. They are expensive stocks, and I think once if a stock is in a momentum, and if the momentum reverses, then in the near term you should expect more volatility and choppiness in across the board some of these stocks.
Oh yeah, absolutely. But we're not done with earnings, and lots of them to react to today as well. You've got Dr. Reddy's, which has been a significant beat actually, led by G Revlimid numbers. So that stands, and that's something that we're going to be looking out for in terms of a reaction this morning. Also, Cipla came out with its numbers. Cipla, remember, has been one outperforming stock all through 2022, and the US business continues to lead growth. Margins have been a beat. And then, of course, Nikunj, the all-important one, Tata Motors, right? It's an all-round beat actually, led by JLR.
Yeah, finally a beat coming from Tata Motors.
And led by JLR.
Led by JLR. But remember, Tata Motors, I think in December, and they came out and they did indicate that the cash flow for JLR will turn positive. So markets knew that directionally things are looking up for JLR, and things perhaps for JLR are moving in the right direction. Having said that, from a market standpoint, I think if one looks at the number and the management commentary, the worst clearly seems to be behind JLR, both in terms of demand and also in terms of availability of chip So incrementally, I think the progress for the JLR business, given the supply constraints are getting sorted and China is opening up, things are moving up in the right direction. But what was missing for me, Aisha, was that there was no big mention about what will happen if there is a plan to do another EV deal, and when are they taking Tata Tech public. So that, I think, was really the missing link. Having said that, the bad news is that they've extended their entire their debt guidance by a couple of quarters, something markets was expecting. So while these numbers are strong, JLR is stable, but they had come out in the middle of the quarter and indicated that. So there is no large surprise per se on that front from a market stock positioning. Brokerages, of course, will come out and they will upgrade their targets. It's a cheap stock which has done nothing. All cylinders are, I mean, directionally, all businesses are in the right direction. So what was more like a contracting business which had a lot of if and buts, I think now things are looking up, but now it's the earnings trajectory which will decide and determine the stock.
Yes, indeed. And brokerages like Nomura, Jefferies have got a buy rating, and you've got JP Morgan, which has a neutral stance on Tata Motors. All right, moving away from the markets for a moment then, and the President has approved the conferment of the prestigious Padma Awards. A total of 106 Padma Awards were announced this year. Late market veteran Rakesh Jhunjhunwala has been conferred with the Padma Shri Award posthumously, and you've got the Padma Bhushan, which has been conferred upon industrialist Kumar Mangalam Birla, as well as social worker Sudha Murthy.
There you go. Those are all the Padma awardees there for you. Well, our markets were shut yesterday because of Republic Day. Cannot say that for the rest of the global markets, right? So what you did see in the US was, a 5-day winning streak, and the stock futures now, meanwhile, treading down in the rest of Asia. Japan's inflation at a 42-year high, and that is taking the rest of the Asian markets up as well. Every morning, my colleague Anisha Jain joins us live on the show to talk to us about a wrap of the global markets, but more importantly, the kind of commentary that you all need to watch out for heading into opening bell. Good morning, Anisha.
Well, good morning. Part of the reason why the US markets ended in the green was better than expected data coming in on the macro front with respect to GDP as well as jobless claims data. And that's exactly what Mohammad El-Erian is talking about. He says that overall this is favorable news that will catch the attention of the Federal Reserve as well. In fact, he says that my broader analysis of economic and financial conditions would favor the Fed raising rates by 50 basis points, also on account of risk management, credibility, and the persistent misalignment between market pricing and central bank's forward policy guidance for 2023. But he's clearly part of a very, very small minority because if you look at the CME survey as well, 99.6% of the participants believe that there is going to be a rate hike by just 25 basis points come February 1st and not really by 50 basis points. But Mohammad El-Erian there making a case for a 50 basis point hike as far as the Fed decision is concerned, but just 0.4% of the participants actually see that happening on February 1st. Shifting focus and talking about what Peter Schiff has to say, he says that by the end of the year, inflation is expected to head higher yet again. In fact, it doesn't take out the 2022 high in 2023. It will do so in 2024. So clearly the messaging from Peter Schiff being that the worst of inflation is not over and we might be headed higher towards the end of 2023 or at least in 2024. Also, he talks about what's happening with gold, and he says investors should not just be looking at gold but also buying gold and in fact silver too. He says that he sees gold headed towards the $2,000 mark just towards the initial part of 2023 itself, and I think silver will enjoy an even larger percentage gain versus the gold. That's the word coming in from Peter Schiff. Shifting focus and talking about a few corporate earnings as well, because that's the flavor of the talk on the town. Let's start with Tesla, wherein the numbers were better than expected, plus the commentary coming in from Elon Musk suggests there's a potential of sale of 2 million cars in 2023, and that led the stock higher. On the other hand, you had Bed Bath & Beyond, which plunged in trading session. That because the company came out with an acknowledgement saying that the balance sheet position is very weak. They're circling around bankruptcy, and that's because they have not been able to meet and repay the credit facilities that they have. And lastly, Intel, a bit of a weak guidance coming in there. We saw an after-sales dip coming in for that counter. For the next quarter, the projections are at the lower end of the range, and this would mean that the revenue would be the smallest quarterly total since 2010, and they're also hinting at a probable loss in the coming quarter, and that definitely had the street nervous.
Many people think that budget is no more relevant. I am of this opinion that even if you are not allowed to fire the crackers, it does not diminish the spirit of Diwali celebration. Let's join on 1st February with me, Vijay Kedia, on ET Now to celebrate Diwali of stock market, Union Budget. See you.
Certainly have the best of experts for you on 1st of February, Union Budget Day. And in the run-up to that, we will, of course, be speaking to leading policy makers, the top CEOs of India Inc., as well as top market experts. Here's Sridhar Sivaram of Enam Holdings with his top wish list when it comes from the Central Exchequer.
If I connect the dots and, listening to what Mr. Bajaj had to say and, some of the other comments that we have seen, this is what I think may happen, that is basically talking of rationalizing the tenure for long term. So today, if you see, the long term capital gains for equity is 1 year, for real estate and REITs is 2 years, and for debt is 3 years. So you're really talking of rationalizing this. It's highly possible that everything moves to 3 years. Okay, so that's number one. The second is that the difference between a long term and short term is only 5%. So you're talking of 10% for long term and 15% for short term. That seems too less. It's highly possible that 15 goes up, maybe to 20, worst case to marginal tax, but we'll know in the budget. The other thing is that the government is looking at rationalizing all savings products which are tax-free today. So they've already, sort of plugged the loophole with capital gains, with say insurance in Europe. There are other insurance products which are tax-free. So what we hear is that is the other possible tinkering around which the government could do. We don't know how this plays out and what all come. If the worst case comes in everything, then that's bad. Which is why I said that some bit is already priced in, and some bit is not. So we will get to know more on the budget day as
Okay, let's move on and let's dissect the market construct on Wednesday and what is it that we're staring at this Friday morning. While the SGX is indicating a calm start, but who knows, we've got 1 day of back data to react to in terms of global cues as well. Naresh Mirani as well as C.A. Rudramurthy join in on the show this morning. Chairman, hi, good morning. Naresh, welcome to the studios. Let's start off. We've managed to cling on to 17,800 support, but the kind of fall that we had on Wednesday, what's your reading into it?
So what we are seeing is there was some bit of a reaction on the banks on, say, day before. But the fact is, if you look at what is happening across the world, there are no risk parameters which have changed. So the dollar index is still below 102 levels. You actually have S&P 500 coming closer to a 200-day moving average cross. Then you have UK FTSE index hitting a new all-time high. European indices are back to June 2021 levels. So as of now, the main thing to wait for is the budget. After that, we need to see whether we break down the levels or not.
So you're saying it's an India-specific thing that
yeah, so that was just a
Wednesday.
one-day event and we've still not broken 17,800. If you look at the small cap indices, they've not corrected as much as the day before. They actually outperformed on a day before. So what we are seeing is it's an impact which was on the heavyweights. So for now, we need to wait post the budget because for a larger correction, say the last move is 17,800 is a support. If such a support breaks, you expect a 500, 800 pointer cut. But for a 500, 800 pointer cut, you need an event which is either global or domestic in nature. Globally, there is no reasons for us to break down. So that's the reason I would wait for the event to then take a call, whether if we can break below 17,800, post the event.
Rudra, hi, morning. Let's get in your take as well, because I recall you saying that if we break below that 18,050 mark, that the downside would be open for more fall. We're decisively below that level, sub the 18K mark as well. What's your assessment as to how we're likely to run up to the big event and what you're seeing by way of levels?
Yeah, thank you so much for giving me that information and remembering what we had discussed on Wednesday. I first want to definitely congratulate Rakesh Junjunwala sir for having got that award of Padma Shri. It is just not for Rakesh ji, but for every one of us who are in stock market. And it is just not for his stock market acumen. Even as a human being, Rakesh sir has done a lot of great things in terms of charity, his philanthropy, and even his learnings to market, which he has given to all of us. With that, let me give you my view on Nifty and Bank Nifty. First of all, we have to understand the fall on Wednesday was not small. 300-point move on Nifty was not small for F&O traders, and especially on an expiry day where delta is very high on options. And in fact, the move of Bank Nifty was much worse, and financials fell like a 29 pin of cards, where you could see 1,000 points kind of a fall in Bank Nifty, which was definitely not small. And for one day, this is too much for especially option buyers. And in fact, my call was to buy options, especially puts, or to sell futures, or even to sell call option, which worked very well. Now, what next? Nifty is now holding that last support of 17,800. Yes, I agree with Nuresh that budget might be the event where you might see that break of 17,800. And once you see that break on a closing basis decisively, markets will open downwards for next another 500 to 800 point kind of a correction. So I'm not saying now it is time to short, because it is all done already on Wednesday. Time to wait out and see what comes out of budget. I won't be surprised if we see a short covering rally also. It might happen, and then we might see another fall. So right now it is avoid call on Nifty as well as Bank Nifty. Watch out for support at 17,800 and resistance at 18,050 level. Bank Nifty support is at 41,500 on futures, and resistance will be at 42,800. So I will wait out for budget now. Already the move on downside I have catched, and I want to now wait out and see what comes out of budget.
Okay, so both our charts over there, C.A. Rudamurthy as well as Naresh Varani, waiting for the big day. And of course, till then, we'll come out with stock-specific money-making ideas, which is what we're moving on to next. Naresh, great to see you in our studio. So you're basically never going to come unless Kunal Bothra is on leave. Is that your strategy? But you know, you once did tell me that you think you look better from home, but I got to tell you, you look better from the studio.
Yeah, so I plan out days when the traffic is going to be low, so it's a long weekend. All right,
Okay,
so going
other
on to
more
the
people?
stock ideas. The sector which I'm picking up the stocks is from the Nifty PSE. If you look at the public sector index, enterprises index, it is on the verge of a multi-year breakout. So the top was in 2017. So that's a sector which I pick up stocks from, and that is where we are seeing a lot of relative outperformance. So both the names are from the oil and gas pack. So first is a buy on ONGC, which continues to be in a higher top, higher bottom formation after a really long time. In the near term, it closed well above 150. Even on the day before when the markets were correcting, it closed at the highest point of the day. Expecting this momentum to continue towards 170, a stop loss to be kept at 147. Second is a buy on GAIL India, which gave a breakout 3-4 sessions back above the 99 mark, has closed around the 101 mark, holding on relatively better in the last 2-3 days of correction in the indices. Expecting this to go towards 115. It has made a very strong base around 85 over the last almost 18 months. Stop loss now to be placed at 97 for this one.
Okay, there you have it, Naresh's top bets. Let's find out then, Rudra, what's making it to your list?
For me, definitely autos will outperform, metals will outperform for 2023. It is only the financials, especially I'm not bullish on, but one has to still buy autos as well as metals for me. So for me, Maruti looks very, very strong. There has been addition in open interest last 2 days. Even in a weak market, Maruti has performed well, and it is holding strong supports at around 8,650. So for me, Maruti is a positional buy. One can even take long in futures. Look at initial targets of 9,000, and eventually stock has to go to that 5 digit of 10,000 plus. I keep a stop loss of 8680, and I want to take positional longs in Maruti. For me, Tata Steel also looks very, very strong. This stock has given a clear breakout above 118 levels, and it is definitely outperforming. And metals for me will be the sector for 2023. So I will look at buying given Tata Steel on any dips closer to 119, 120 zone. Keep a tight stop loss of 118 and look at targets of 129 initially, and eventually 160 to 180 will come in Tata Steel in 2023. So for me, autos and metals will be on the buy list.
Okay, metals and auto on the buying list for CA Rudramurthy on, before Republic Day on Wednesday. I remember he had all sell calls and from the real estate pack. Okay, so that's the top picks that are coming in from both our chartists as we head towards opening bell. And with that, we've had big earnings, of course, that have been coming in. We're going to be discussing that and more, and strategies headed towards a union budget speech, all after the short break.
Welcome back. Let's focus in then on some top fundamental stock ideas then. And Chakri Lokpriya shared his view on banks. Let's listen in as to why he remains bullish.
Top three holdings are still banks. It is SBI, Bank of India, as well as Canara Bank. So they all three are banks, and because for all the reasons that we just discussed, I think valuations are clearly on their side. The banks are far better than they were. Their ROAs are improving, and second, now they have a business catalyst in terms of infrastructure spend, which usually the borrowing happens from PSU banks.
Hi, my name is Shashank Shrivastava. I am from Maruti Suzuki, and I'll be taking a close look at the forthcoming union budget from the auto industry perspective. Auto industry, as you know, has had 3 really tough years, and in fact the last year was actually good from a volume perspective, but the challenges continue. So I'll be talking about the expectations from the industry regarding how to make growth a reality for this industry. So tune in to ET Now as I decode the union budget from an auto industry perspective.
Best of experts only on your channel on 1st of February. I mean, the thick of earnings season, and watch out for Dixon Technologies, because what we've seen is actually, numbers below what the street was expecting. But what we need to watch out for from the reaction is how the revenues and the margins guidance has been cut by the company. Is there a slowdown in client addition? What will be the outlook for margins going forward? Why has there been a revenue guidance cut as well? That and more is what I'm going to be discussing with Atul Lal, the Vice Chairman and MD of the company, now joining us here on the channel to talk about the third quarter that's gone by, which Mr. Lal was clearly a very tough one when we look at the numbers. But more than that, the way we've seen the revenue guidance being cut to 12,000 crores. Earlier, it was 15,000 crores. So what made you do this? 12,000 crores. And can you give us any guidance for the new financial year?
So the revenue targets, we have had a relook at it because of a couple of reasons. One reason is slowdown on the mobile side, particularly on the export front side, which has had an impact. And the second one is the decline in the unit value of LED television, which is a large business for us. As far as the volume is concerned, that's as per the budgeted plans. So these were the two challenges, and that's the reason there has been a revision in the budgetary estimate. The positive has been that there has been a significant margin expansion and also strengthening of the balance sheet by significant reduction in debt, which will further improve our ROCE. For the next year's guidance, we are still in the budgeting exercise. We are doing their internal numbering, and we'll revert to you later. But please be rest assured, we are committed to a significant growth phase.
Okay, fair enough. We'll look forward to a little more clarity on that margin guidance as well down the line. But Mr. Lal, you had also spoken about a slowdown in Q3 for mobiles. Are you seeing a bounce back here, or will your mobile revenue continue to remain under pressure for the next few quarters?
So at present, there is slight recovery on the domestic front side. On the export side, we feel that it's going to take some time for the order book to strengthen. In the meanwhile, we're working on some new customer acquisitions. We are fairly confident those customer acquisitions are going to conclude in a short span of time, which will significantly improve the mobile numbers also.
Okay, so we'll wait for you to give us an update on when you have those new clients. Can we make a conclusion, Mr. Lal, that therefore, because of what you're seeing in Europe and US and the kind of conversation we're having, hard landing, soft landing, is this the start maybe of the export-oriented business taking a further knock? Because we don't know when that is going to come out in the green. You've talked about the revenue guidance cut. We still need to talk about the margin guidance cut as well.
So the margins in our case are going to expand. They're going to expand by 30, 40 bits. So we can see a margin expansion because of significant value engineering, cost optimization, operating leverage generated through scale. Combination of all these factors, you will see a marginal increase on the margin profile. As far as the demand recovery on the export side is concerned, we are sanguine about it. We are watching it very closely. We feel that the new customer acquisitions, not only in mobile but also in our other businesses, is going to help us in building up our export base.
Okay, just looking at your overall, segmental performance, and your mobile phone revenues as well have come in lower by about 43%. Just looking at the outlook on the TV segment, etc., lighting, consumer electricals, across the board, there has been a slight slowdown. I just want to understand for the TV segment, there would have been some realization decline, which led to the revenues overall declining. Can you give us a sense as to what the outlook is on volumes and what is the industry demand like?
So we are the largest manufacturers of LED televisions in India. Please appreciate that the market as such has not grown in the present financial. However, our volumes are going to grow by almost 18 to 20%. So volume growth is very healthy. As far as the value is concerned, an average TV value in the year 21-22 was approximately 17,000 rupees. Due to a significant decline in the major input, that is the open cell, the average value has come down to almost 11,000 rupees. And that's the reason the revenue is under pressure. The volume growth is going to be 18-20% in the current fiscal itself. So that's the scenario on the television front. And also, not only the volume growth is healthy, also the margin profiles have significantly improved.
Okay, Mr. Lal, we're going to leave it at that. So that is the company's reaction when it comes to, making sure the revenues stay around these kind of levels as we see recession in its where it does business in areas like Europe as well as US. Revenue guidance cut from 15,000 crores to 12,000 crores as there's a slowdown for mobile phones in overseas geographies. Mr. Lal, thank you so much for being here with us. The good part news, of course, will be that going forward, we're going to see margin expansion. And with that, I'd like to invite Sandeep Sabharwal, who's going to be live with us now. Good morning, Sandeep. I was going through your Twitter profile. I can see you have one thing on your mind, which is Pathan, Pathan, and Pathan.
That's largely due to all these, I think, all these boycott calls and all, which I don't agree with. So I just keep on quoting them. So that's it. So I don't think we'll discuss more on that till I see the movie on Sunday. Then I'll comment more on Monday.
Okay, so Sandeep Sabharwal has bought the tickets till last week. He and Aisha on live television were discussing how they're not going to maybe buy the ticket and see it in the multiplex, but wait for it at the OTT. Okay, Sandeep Sabharwal, should we begin with the Adani FPO?
Yeah, so I think the FPO, like we discussed last time, although I don't track Adani stocks and I don't buy them, was important for the group simply because of the fact that they have a very high leverage. And this fundraising was important for the systematic risk, both in the stock markets as well as for the banking sector to get controlled. So I think the way it looks, the FPO should go through, and that will be a relief for the group overall.
Okay, that's the take coming in on all that transpired with the Adani Group of names in Wednesday's trading session. TVS Motors, that was the one which was fairly resilient in Wednesday's session. That held out quite smartly. There was Bajaj Auto as well, which looked good. And of course, today the street is going to be reacting to Tata Motors numbers. And Naresh, we've been talking about as to how, you know, the previous year belonged to M&M and a TVS, and this year could very well be Tata Motors year, right?
So absolutely watching the chart very, very closely because it's spent almost, you could call it a year and a half consolidating. And irrespective of all the bad news over the last 1 year, every time the stock would go to 380, 400, it has bounced back. And on the upper end, 450, 440 remains a problem for the stock for the last 3-4 months. So watching out if it can sustain above 440 levels, that would be the first indication of a trend change for Tata Motors. One thing is clear, the consolidation has been done with, so over the next few months it should take a directional move, whether it has to break that 400 mark or 440 mark. As of now, the bias looks positive, but waiting for price action to confirm the bias.
All right, let's discuss then the auto numbers in greater detail. And we had Tata Motors, of course, that came out with their earnings. It was, in fact, the company managed to post the first quarter of profits after 7 straight quarters of a loss. And then there was also Bajaj Auto, pretty stellar set of numbers. Let's take it across then to Shrishti, my colleague who tracks the sector. She gives us a lowdown on the Q3 numbers. Shrishti.
Well, yes, two auto companies reporting their numbers. Firstly is Tata Motors. This time around, a stellar set coming in from the company, where the company turns profitable after 7 consecutive quarters of losses. That's the first headline we are getting to gather from the company. But the other big headline is that they have now pushed their JLR net debt zero guidance by another 7 to 8 months, because their guidance was to be net debt auto zero by FY24 for all their divisions, because on a FY23 YTD basis, their net debt has come in at 57,500 crores. In that, the JLR accounts for 38,000 crores of net debt. But going forward, the guidance to be zero on the net debt basis has been pushed for next 7 to 8 months, specifically for their JLR division. But let's talk about Tata Motors' number, a stellar set this time around, versus our estimates of 285 crores of profit. The company clocked in a profit of 3,043 crores. The margins have expanded to 11% this time around. The consolidated revenue is up 23% on a YY basis. The EBIT, the JLR free cash flow has come in at 490 million pounds, and the EBIT margin is at in line at 3.7%. So a great show on all the parameters, but just that the net debt zero guidance has been pushed. Coming to Bajaj Auto numbers, definitely a good set, a beat on all the parameters here. The margins have expanded to 19.1% versus our expectation of 17%. Revenue has been jumped by 3% on a YY basis. Profit grew by 23%, and the EBITDA saw a growth of 29% on a YY basis at 1,777 crores. What the company is highlighting is that their EBITDA has been the highest ever, margin expansion led by judicious pricing as well as richer product mix, and going ahead, they do share a positive outlook for the sales.
Powered by 1 billion consumers, India has now emerged to be the world's fastest growing large economy. In this budget, will the Finance Minister announce measures and policy initiatives that will boost consumption in India? Join me, Nilesh Shah, as I analyze the budget on ET Now.
Okay. Well, apologies, was busy checking something on the phone. Didn't realize the ads over. Tata Motors we've already discussed, but I'm going to talk about Cipla and Dr. Reddy. Sandeep, both the numbers have been a miss, especially Cipla. Yet brokerages are still maintaining outperform on at least Cipla and Dr. Reddy. Are we at that turn where worst of the bad news is behind us, the COVID sugar rush is over, and now incrementally for FY24 and FY25, these stocks could have different earnings trajectory?
Cipla has done well for itself in terms of performance. It did well for several quarters. Last couple of quarters, it's been disappointing on earnings. So I think that's led to stock price stagnation. I would think that it could still continue for some time. I don't see a big sell-off, but I don't see any big upside in the near term. Dr. Reddy's, obviously, the strong earnings were driven by some particular products, which actually makes the pharma industry very tough to analyze because specific products in specific quarters drives earnings. But I think it's well placed at this price. I think the stock is cheap relative to fundamentals. There is upside in Dr. Reddy's, although it might not be very huge, but I would think that there is a decent upside for the next 1 year.
Into Tata Motors numbers, it is a beat on all counts, but that zero debt, or rather net zero debt guidance has been pushed back a little bit. I guess that's something that the market must have already anticipated.
Yeah, that's known. How can a company with a 85,000 crore debt suddenly go to zero debt? So they had some aspirational levels which were not achieved. But directionally, I think things have turned around. The beat on earnings is very, very significant. So the critical point for Tata Motors always was that the operating leverage is so huge that once the turnaround happens and if it sustains, then the profits which will come will be so large that the stock becomes suddenly very cheap. Now, most analysts have projections of 30 to 50 rupees EPS for next year. And I think the stock is cheap. So we have actually bought into Tata Motors after a long time in first half of January, and I think there could be significant upsides over the next 2 years.
The new independent addition to the portfolio. Sandeep?
Sorry?
Did you sell Mahindra and bought Tata Motors, or this is an independent position you've added and you still hold Mahindra and Mahindra?
No, Mahindra I'm not selling. I think that company's got so much going for it. Their product profile is so good. It still trades at valuations which are cheap relative to fundamentals, and farm equipment business actually picking up delivering profits could be an additional kicker. So I don't see myself selling M&M anytime soon unless and until either the stock runs up too much or the company starts disappointing.
Okay, so that's M&M for you, high by 50% in the last 1 year. And Sandeep Sabharwal, quite clear, he's not selling it from his portfolio just yet. Right, the next 10 years belong to India. We've been talking about that here, and here is veteran banker KV Kamath explaining why the next 10 years belong to India. This is in the run-up, of course, to the big event next week, 1st February, Union Budget. What are KV Kamath's expectations? Here he is, setting the agenda for the Central Exchequer.
Barring some external shocks which could be geopolitical in nature, or it really could be because of energy and high inflation, this decade belongs to India, and you're quite certain and confident about it?
Yeah, I am absolutely certain about it, Nikhil. And the test was the last 3 years. If we could not have managed ourselves during those last 3 years of enormous distress, could not have reset our minds, could not have pumped in technology into what we are doing, I think I would not have had the confidence to say this. But having done all those things, I can confidently say that the next 10 years are ours to win, and we will win those 10 years.
Our expectations from the budget are based on 3 key themes. The first one being a budget that stimulates growth, as has been in the previous budgets of the last few years. The second is supporting the infrastructure growth, because infrastructure growth is key to the development of travel and hospitality business in India. And finally, a tourism booster. It is time that this sector gets a booster dose so that the sector that suffered the most, demonstrated the highest level of resilience, is not only coming back on its feet, rather is contributing the maximum in terms of new job creation as well as indirect job creation.
The dollar index is almost at 101, 115 has become 101. How extraordinary is that? Who would have thought that first it will go to 115 and from 115 in a matter of 4 months it will come back. Nifty or SGX is above 18,000, thank you. 18,000, you trade above that, psychologically you just feel happy about it, don't you? Most of the Asian markets are trading with a positive bias, and SGX, if you look at a sum total of what the move yesterday was, that means, Nuresh, just break it for our viewers. Yesterday SGX was trading while we were off. SGX is trading with a positive bias, which means we are in for a gap up start of at least 100 points plus.
So, a 100-point gap up would be normal, but the fact is, can we hold on to it till the event is not out of the picture, right? We are seeing this floppy moves. Say, last week we went towards 18,200, it seemed like it would break out. Yesterday, day before we went towards 17,900, it seemed like 17,800 would give way. Neither of it is happening, and I don't expect it to happen at least up till 1st of Feb. But when we look at globally, like you looked at the dollar index. Now, when you look at the dollar index, what is the interesting part, right? So 2020, when the COVID peak happened, it was at 101, 104 levels. Back in 2017, when there was a correction, 2016-17, it was 101, 102 levels. And if you go back all the way over the last 20 years, some of the best bull markets have happened below the 100 point for the emerging markets.
The dollar index below 100, can you just draw the timeline for us and then we'll talk about it?
So the last it was below 100 was last year in April.
Okay.
And before that, if you go back all the way, only when we started, it was all the way below 100 only, but it started breaking down in June 2020. Okay. Right. So if you go back all the last 15, 20 years, the best of the Indian market's best periods have been when the dollar index is below 100. So we are getting closer to the price point. So if you look at all the parameters globally, we are at a very different case. Indian markets are sideways. We had a period of time last, say a few months back where India was outperforming. Today, for example, Hong Kong index is up almost 45% from the lows.
Yeah.
That is huge. And their IT index is much more. Then you go at FTSE, which is UK, is at an all-time high after maybe almost 15 years. DAX, which was the most hit index because of Russia, Ukraine, is higher than the June 21 prices. And you can see, you can pick up a Mexico market, you can pick up anything. Across the world, actually India has been the major underperformer in the last, say, 2 weeks or 6 weeks. So budget could be that trigger which would make that move. Say, the view is 17,800 breaks, everyone is like it should give a breakdown. If it gives a breakdown, you need a 500,000 pointer cut. Can we get a 1,000 pointer cut when all the global markets are actually nearing a breakout? S&P 500 today is above the 200-day moving average. The breadth is improving across US markets. So I think globally there are not many reasons for a breakdown. So even if we see a little bit of a correction, we may not see that move to 500,000 pointer cut. So one has to start looking at, and if you look at the mid cap and the small cap index, we are already at 17,200. Post the correction in the
and maybe
near
more
term.
In stocks. There are so many stocks which are down 20,
Exactly.
30, 40% that you cannot draw a parallel number to that on the Nifty.
Exactly.
And that's such a valid point, Aisha. Global markets are not, the global setup is such that you're not going to fall a lot, and typically when the dollar index is on the decline, emerging markets like India will always do well. So the global setup will ensure that the fall is going to be limited and restricted. Now is outperformance. Outperformance is a function of what we did last year. We were here, other markets went down. Other markets have started coming up. So with each passing day, if global markets continue to move higher, the gap actually reduces.
Yeah.
So the
I think
premium
the only
position
outlier
reduces.
here could be the budget, and if there is any tampering on LTCG and the quantum of that, then of course you could see a very knee-jerk reaction coming in. Will we then sustain 17,800? That's a little bit questionable.
You know, Aisha, when STT was introduced, the first reaction was, oh my God, it's going to be end of the world, because the tax like that never came.
But you did have that knee-jerk reaction, right? So I'm
it
only talking,
lasted
I mean, nothing challenges the long-term story of India. But Sandeep, what do you think? You think that that budget event could be a big outlier and we could see this way or that a move for the market?
I think given the severe underperformance we've seen, the probability that we move higher after the budget is much greater given the global context. If you see, globally markets have shown great resilience even after news of job cuts, disappointing earnings, etc. Things have picked up because the overall outlook is turning towards a soft landing kind of thing. Now, in India, unless and until they actually do some drastic changes on taxation, which will be taken very negatively and which reduces the post-tax returns of equities, I don't see it impacting negatively. I would think that this is the last budget before general elections of next year, and it might be taken up as a means to actually put some more money in the pockets of consumers via changes on the taxation brackets, etc. So let's see how that goes.
Number one, the long-term taxes, which currently are at 10%, goes to 15, in line with short-term. What happens in that case?
So long term going same as short term makes no sense. So I don't think that will happen. If at all, what's been talked of has been that equities enjoy a special status where the long term is calculated only for 1 year, whereas for all other asset classes it's much longer. So whether everything will be brought at par. So if it is brought at par, some traders might become negative, but I don't see it as a major negative as such.
The point is that if I see the cultural shift in India, the cultural shift in India has happened to SIP flows. When people, when somebody starting an SIP, they are not thinking months and years and days and weeks. They are thinking about decades and at least 5 year plus. So for a genuine long-term investor, I guess if you sell after 1 year or after 2 year, if you're in for 3 to 4 years, frankly, nothing changes in your life. One. Second, sometimes when you are not able to sell something for more than 2 years and if you bought into good stocks, that actually works to your advantage, because in an economy where directionally things are moving higher, if you end up buying stocks for 2-3 years, you actually end up getting higher returns, where if the lock-in period was not there, the temptation to get out something immediately after a year would have been higher. And I'm speaking out of what I've seen over the years, that when you hold a good stock for years, then the return automatically changes depending on your time frame. So this actually, Sandeep, I feel that we are in an uptrend in terms of economy, we are in a high growth mode, and if the duration of long term is changed from 1 year to 2 year, where not by choice but by force, if you are allowed to, you have to hold stocks for more than a year, this actually could be a blessing in disguise.
Yeah, it's not negative. It's a change. So I think if all asset classes come at par, you need simplifications of tax laws in any case. So if that happens, and if there's some knee-jerk reaction due to that, I think it should be an opportunity to buy. If they increase the overall tax level, then on a post-tax basis, equity returns come down. So that could have a slightly more longer-term impact, although that will also get taken out if the economy does well.
Okay, so that's the word that's coming in from our experts with a big event on 1st of February. We were talking about decoupling late of 2022 in the new year. The Indian stock market, of course, not doing what we have gotten used to. In fact, underperforming the rest of the world. Can Finance Minister Nirmala Sitharaman provide a booster shot to once again attract FIIs, bring them back to India? We're all on countdown with all of you till the 1st of February. Right, we will also be getting you picks from the broader markets from our experts, but let's just stay with some certain stocks that are, of course, standing out. I will be looking at stocks where we've seen volumes as well as price action. Sandeep Sabharwal, you've got Zomato once again available for less than $50 a share, down by 8.5%. Would you be a buyer at this price?
I think the recent fall in Zomato started after Swiggy came out with its previous year number, which showed a huge increase in losses, and then on top of that, we had news of layoffs, etc., happening. So I think in a growth industry, if these companies are having to lay off, then that raises concerns on growth. So I would think wait it out and see how the next couple of quarters go.
Okay, so wait it out and see how the Zomato stock settles. Well, that time of the show where we also get your ideas from the broader markets. So let's go across to our charts just for that. Naresh, what's made it to your list today?
That's a small cap called Kirloskar Ferrous, one of the few stocks which is actually trending up, and the whole group, Kirloskar Group, has been trending up in the current market. So if you look at the stock is closer to a 52-week high and an all-time high. Did not see a correction over the last 2 weeks. The last high for the stock is closer to that 375 mark. So waiting for a breakout here. If this continues, the next leg of the move could take it to 450 levels. Stop loss at 340. So a buy at current levels as well as on dips.
Okay, Rudra, let's find out your mid-cap call.
For me, IT as a sector might be post another quarter will definitely become more attractive. And as an investor, I would definitely look at IT as a sector. It is just another quarter of pain and valuations are very comfortable. Also on chart, I want to pick this mid-cap IT stock called Onward Technology. Personally, me as well as my family member and clients have good positions on the same. As a disclosure, I'm putting it across. And Onward Technology on chart has given a clear breakout above 310, and it is just making that accumulation patterns right now, and stock is looking very, very strong, looking at initial targets of 400, and one can now keep a tight stop loss of 325 and go long on Onward Technology.
Okay, let's tell you what else is making the headlines outside the world of markets. And the customary halwa ceremony was held to mark the final stage of the budget preparation yesterday. Remember, after this halwa ceremony, the officials involved in the budget making process are locked in at North Block till the budget day. Also, Hasbro said that it would eliminate around 1,000 employee positions and warned of weak holiday quarter results. The layoffs come as the company seeks to save between $250 million to about $300 million annually by the end of 2025. Hasbro said that it expects fourth quarter revenue, which includes the holiday season, to reach $1.68 billion. That's a downtick of about 17%. Also, Elon Musk said that a Chinese automaker is likely to be the closest competitor to Tesla, while stressing the company is winning in China. Right now, Tesla has a number of challengers in China in the EV space, including a slew of startups such as Neo Xipeng and Li Auto as well. Tesla's biggest rival in China right now is Warren Buffett-backed automaker BYD.
Moving on, after taking over Air India, reports suggest that Tata Sons may invest up to $1.8 billion in the proposed airline behemoth created by the merger of Air India and Vistara. Remember, on the 29th of November 2022, Singapore Airlines and Tata Sons plan to merge Air India with Vistara, with Singapore Airlines holding 25.1% stake of the merged entity. And Sania Mirza and Rohan Bopanna lost the final of the mixed doubles to the Brazilian pair at Rod Laver Arena in the Australian Open. Despite valiant efforts from the 36-year-old Sania, she could not achieve the fairy tale ending expected from her journey in Grand Slams. She ended with 6 doubles titles in her illustrious career.
Whether it will be a budget which has lot of populist measures, or will it be a budget where fiscal prudence gets precedence over everything else? Will it be a infra-led growth or a consumption or demand-led growth? I will dissect along with many other panelists on ET Now on 1st February. Watch me on ET Now.